Bitcoin traders lose 90% of their capital because they rely on isolated, lagging data models. If you only look at stock to flow, you are missing the institutional liquidation signals that actually drive price exhaustion. I have mapped the three core models that predict these shifts before the charts even move. Stop betting on single indicators. These are the technical mechanics that reveal when the whales are preparing to dump. And let's get to it. If you want to track where Bitcoin is headed, you have to stop looking at random social media posts and start looking at the actual on chain mechanics that dictate supply and demand. Most people treat market analysis like a weather forecast. They think they can just predict the rain. But the crypto market is more like a high stakes physics experiment where the variables are hard coded into the protocol. Let us start with the first model, which is the stock to flow ratio. This model looks at the scarcity of an asset by measuring the current supply against the rate of new production. Think of gold. Because the existing supply of gold is massive compared to how much is mined each year, the stock to flow ratio is high, which historically keeps its value stable. Bitcoin was designed to follow this exact logic. Every 4 years, the amount of Bitcoin produced by miners is cut in half, an event we call the halving. The data from the past decade shows a remarkably tight correlation between these halving cycles and the major bull runs of Bitcoin. For instance, in November 28, 2012, the first halving occurred and Bitcoin surged from $12 to over $1,000 by the following year. Then, in July 9, 2020, the second halving kicked in, and we saw another massive climb as the difficulty of minting new coins increased. This model gives you a solid foundation for understanding long-term price appreciation because it relies on the fixed supply constraints of the Bitcoin protocol. It is the easy win because it is predictable. You do not need to be a Wall Street trader to understand that when the supply growth slows down, the price pressure tends to go up. But here is the nuance. The stock to flow model only accounts for supply. It ignores the reality of demand. If you rely on this alone, you will be caught off guard by external economic shocks. That leads us to the second, more sophisticated model, the realized cap model. This is where things get interesting. Instead of looking at the total market capitalization, which counts every single coin ever mined as if it is worth the current market price, the realized cap measures the price at which each coin last moved on the blockchain. Think about that. If you bought Bitcoin 10 years ago at $10, your specific contribution to the realized cap is $10, not the current $60,000 market price. This creates a metric that effectively tracks the aggregate cost basis of all holders. When the market price is well above the realized cap, we are in a profit-taking zone where traders are often liquidating positions. Conversely, when the market price dips near or below the realized cap, the data shows that holders are underwater, which usually signals a capitulation bottom. During the crash of March 12, 2020, we saw the market price plunge momentarily below the realized price. Investors who looked at this data realized it was the ultimate buying opportunity because the entire market was priced lower than what people had actually paid for their holdings. It is a much more grounded way to measure sentiment than just watching green and red candles. If you are finding this breakdown helpful, consider subscribing. We dive into these data-driven models every single week, and you really do not want to miss the analysis I have coming up in the next few episodes. Now, okay, you have the supply side logic of the stock to flow model, and you have the realized cap for measuring holder sentiment. But there is one more metric, and honestly, it is the one I use to judge if a cycle is actually peaking. It is called the MVRV Z-score. MVRV stands for market value to realized value. The Z-score standardizes the ratio, telling us how many standard deviations the market value is from the realized value. When the Z-score enters the red zone, typically above 7 or 8, the data shows that Bitcoin is statistically overvalued compared to its historic cost basis. In almost every single market cycle, when the Z-score hits these extreme highs, the price follows with a massive correction within a few months. Think of it as a speedometer for market euphoria. It is the moment when greed mathematically overwhelms the fundamental value of the network. During the 2021 bull run, when Bitcoin hit nearly $64,000, the Z-score gave us a clear warning that the market was overheating, even while news outlets were still calling for six-figure prices within weeks. That data point saved so many investors from buying the absolute top. Let that sink in. When you combine these three models, you go from guessing to having a tactical framework. You use the stock to flow to understand the long-term trend, you use the realized cap to identify support zones, and you use the MVRV Z-score to determine when the market has finally gone too far. Once you see the charts through these lenses, you simply cannot unsee them. The noise of the 24-hour news cycle starts to fade away, and the mechanical reality of the blockchain becomes clear. You stop reacting to headlines and start looking at the objective state of the ledger. And really, that is the difference between a gambler and a researcher. Remember that none of this is financial advice, but it is a way to look at the market that actually tracks with the history of the asset. The data does not have a bias. It does not get scared when the price drops, and it does not get overconfident when the price hits a new high. It just reports the facts. If you want to master these models, start by checking the MVRV Z-score once a week. Compare it to previous years, like 2013 and 2017, and you will start to see the patterns emerging on your own. There is no magic formula, just careful observation of how money flows through the network. So there you go. Three models that provide a complete picture of Bitcoin's life cycle. The first two give you the trend, but that third one, it is the indicator that acts as your exit signal. That is a level of insight most people who jump into crypto on a whim will never even bother to discover. You are already ahead of the curve just by paying attention to the fundamentals. If this video helped you clear up the confusion, share it with a friend who is still trying to figure out what drives these price movements. Subscribe to the channel so you do not miss my deep dive into the next market indicator, and I will see you in the next one. Keep digging into the data. It is the only way to be certain in an uncertain market.